did a study on 380,000 companies in the first 5 and 10 years of the growth path. So it's the growth strategies, which we did through the business school, my colleagues, which is a global team. We hope to include Singapore in the next phase. Let's hope for that. I have to have a working definition of venture capital here because Asia predominantly is a growth capital play. And being this a growth capital play, it often doesn't qualify to be VC. And so the way we define it, it's multi-rounds of financing of any stage of the company prior to an exit with institutional venture capital money. And I do not only go by first, second, third, and fourth round. I'm coming back to this on the next slide because in this definition we can never compare companies. I'm coming back to this on the next slide. So I break them down by other stages. And by other stages I mean, how do I define to benchmark companies around the world in the VC industry? I don't go by first, second, third round as I just mentioned. The reason, I'll explain you this in a second, is I go by pre-revenue companies, so the startups, and then followed by the product and service development. That's all pre-revenue. And in some internet companies, this goes very quick. In life sciences, this can be 5, 6, 7, 8, 9 years to get just to that point that we are looking at. And then the revenue companies are pre-profit companies, and then you have the profitable companies. And that's the only way I do for 10 years where you can benchmark VC industries around the world and companies in any of the sectors as a comparable around the world. And the reason is, in Asia, typically they call revenue, pre-profit, early revenue, they call it early stage, because the whole VC industry, almost across entire Asia, is predominantly in that space. And I'll show you the data today. So here are the 5 items we're going to look at. It's the drivers of emerging venture ecosystems. Just a few slides. I could go the whole day on that one alone. Global VC investment benchmark, the exit, then the global corporate play. When I talk on innovation, on 2 levels of innovation primarily, which is technology innovation and also business model innovation. But I think what's really changing is, if you look at the advanced economies today, or mature economies, whatever you want to call it, you typically have, when they talk about innovation, a substantial technology layer with solutions next and business model on the top. Asia's play is almost the absolute opposite, which is predominantly a business model play, big time. And by the way, that's something the Westerners have completely underestimated in Asia. Solutions and technologies. That's a sort of most emerging nations at this point in time. I would probably think that Singapore, given where it is today, is probably somewhere a pretty good mix or blend in it if they played. Long term, this is an extreme outlook. Long term, I believe that, you see, the Westerners, they need to open up. If they want to play in the emerging markets, they need to open up much more on the business model play. And I think the emerging markets, they need to up much more on homegrown indigenous technologies as well. So that's in the absolute extreme. You know, I don't know if it's 20, 30, 40 years, I don't know by when, but just to open a bit the eyes, that's where I see the market move over time. You know those graphs. I only show once, typically representative of the growth of the particularly the BRICS and the other high growth economies. And all I wanted to highlight is this is a great play actually for VCs to be in. VCs love to invest in high growth, underserved markets. That's really where the play is for VCs. That's why the high growth economies now are a substantial, phenomenal play if you really look at this. And I don't need to go through any of those graphs because I'm sure you have seen many of them. However, over the years, we have developed, and I've developed a model which I call the venture capital model for emerging market. And typically, this is pretty much the case. It works like, if I look at the axis, it's the sector development. Left on the bottom is the low-tech sector, retail, into high-tech and other sectors on the right-hand side over time, and from late stage to early stage. And this is how most markets actually evolve, or hopefully will evolve, and we'll probably have a discussion later where Singapore fits in. So in the first place, you have the foreign VCs flying into these high growth emerging markets. late stage, low risk investments. And you have the returnees, which are being funded by the foreign VCs typically coming in. And then lastly, you have some government funding and focusing just on a few key cities and hubs. That's very, very common. The next stage is the growing stage. So the growing stage is more local and foreign VCs actually setting up their shop physically on ground and taking on some later stage tech deals. Tech deals doesn't come early. It's just an additional layer of risk. You have the three key risks, which is technology in the very first place, then you have market risk and you have management risk. And so VCs typically don't like to go into tech when they enter a new emerging market. It's just an additional layer of risk. The first local entrepreneurs turn VCs, typically around that time. The second, third tier cities come into play, and then the business angels and the corporate VCs start playing in that market as well. And then lastly, in a maturing market, you have specialized VCs by sectors, by stages. You have more early stage deals, more tech deals coming up, nationwide international market access. So that's kind of the interplay LPs, VCs, and acquisitions. So I'm coming back to this number of different stages in the different markets that we are going to look at. Another thing I've been looking at for about 10 years is startups going international and global. And I have different charts, and I just picked one of it. It's a kind of a more recent one, where you can see in the US, let's take the top left one. In the US, what you have is you have a lot of Europeans also playing in the US. You have 10,000 currently venture-funded active companies, and about 1,000 are from overseas, on top of it. And so you see Canadians, some Chinese, some Indians, a number of Israelis, and then the Europeans. The same thing in Israel. It's basically the US-Israeli play. You have a total absence of sort of like Chinese, Israelis, same in Canada. And if you look in Europe, very few Chinese, very few Indians showing up at a big play naturally by the US. And then as you move on into China, it is still a strong US, European-centric. And now the Israelis start in. They are providing a lot of technologies, more and more. And what also the Israelis do is they use a lot of outsourcing into China, and naturally also starting increasingly now also in India. I'll talk about maybe later more also on startups, and I can tell you already up front, I just came from India. This is the last 3 days of my 70 days around the world. I do this twice. One is 100 days, one is 70 days, and I have some additional travel. But what I'm trying to tell you is Eastern Europe is going to be an amazing place to look at, to watch, from a technology perspective. So I'm coming back to this. So I didn't put this yet. I will get the data next year. And then something else, I just want to highlight how typically the markets in US, Europe, Israel, China, just as a benchmark, even when it comes to headcounts, how they differ. So this is venture-backed companies. And if you look at, I always look at the black ones are profitable companies. This is revenue pre-profit, product development in yellow, and then the green one are startups. So if you look at those markets, you can see that a typical Chinese companies in a mature, which is a profitable company, is about 150 employees versus 50 versus 30 and 30. So the Chinese companies are dramatically bigger by any dimension. I'm always joking, say add a zero. And the same in healthcare, because most of it you will see is because also of healthcare services. The same up here, by the way. Let me show you the real underlying data in a minute. And then same in business consumer services. You have about 290 here versus 70 even versus 30 in Europe. That shows you how very, very different the companies at the same stage of development, how they are in terms of size. So let's look at the actual VC benchmark here. Just historically over time, without going into the details, you can actually see that the US, even if the numbers vary, what's striking me, because that was really against the odds, is maintains almost a plus minus 70% portion over the years, even in a downturn. That means the whole world comes down, but they will still keep a 70%. That's stunning, meaning VCs investing in, investments into US portfolio companies. Well, they may also invest in the high growth nations, but this is really looking at investments into US portfolio companies. And then you could see that Europe is getting smaller and smaller. That scares me. I'm a Swiss, so I'm telling you, we are risking to get below the critical mass level very soon. But there's some other mechanisms like in Singapore, so there will be no clean tech, no biotech space in Europe without the governments. Let's be very clear on this. And then you see China, actually China is going to surpass Europe guaranteed this year. Even if it's a much more late stage play, we'll come to this in a minute. And then India is and remains smaller in terms of venture by venture definition. The growth capital play is huge. Okay, I mean huge in terms of absolute amounts being invested. And I'll show you some of the stuff coming up. And then Canada remains a kind of super flat, even slightly decreasing, constant play. Actually, great deals in Canada at a much lower price than in US at equal quality. So some US VCs have now figured out that actually Canada is a pretty cool play in certain types of IT and clean tech in particular. So that is the Q3 data. So I'm expecting probably to surpass, at least maintain or slightly surpass the previous year's level by the end of this year. If looked at an absolute scale, these are the number of companies invested in the US. And you can see the US in blue is still the big elephant and dinosaur. You see Europe in terms of number of deals, still sort of reasonably big size. China, number of deals, and India in green, much less. However, when it comes to the dollar amount, again, US is the big dinosaur, Europe substantially smaller. And what does that mean? That means Europe invests substantially less average per deal. Sometimes, in my view, trust me, even too small. If the US overspends in some companies, Europe underspends. And that has an issue also on growth, by the way. And you can see that now China is just about closer and closer, and wouldn't surprise me at the year end it's going to overtake even entire Europe from a venture investment perspective, although it's a late stage play, but by the same definition. If we look at the hotbeds around the world, then you can see again, needless to say, Silicon Valley, New England, New York Metro, Southern California, UK, and then Beijing, Shanghai in terms of dollar amounts coming in. Bangalore still at the far end on the right-hand side as one of the leading hotbeds out of India. And then on the right-hand side, in terms of number of companies, in the first half of this year, so Beijing and the Shanghai, Bangalore on the right-hand side. So this is what I like to show you next. I want you to, if you walk out on something that's a sort of around this element that I'd like to explain to you, this is something I've been doing now for almost 10 years. And in really understanding the global venture space, how it works. If you look at if I take all the investments in Europe, US, China, and India, if I take all those investments into startup product development, remember that is the pre-revenue side, right? You can see that a very small percentage of all the money actually goes into the startups, which makes sense. They need a little money. I have the same slides. I can't show all in number of deals, but it's relatively small. When you look at product development, you can see that about 20 to 40% in that range, 20, 30%, US and Europe maintain a fairly stable level. So they like to invest in product development, pre-revenue type of companies. India is a bit odd, has a small number base, and if a few deals get done, it may skew the picture a bit in terms of absolute percentage of amounts. So with India, need to be a bit careful. However, if we go to the revenue generating, pre-profit and profitable companies, you can see that the global sweet spot, oh, sorry, that was the wrong one. The global sweet spot here is revenue pre-profit. That's really the global sweet spot. You have US and Europe probably in the range around plus minus 50%, 55%. And then you have China anywhere from about 50 to 60% in general in red. And then you see India's really super sweet spot. Almost all the money actually goes into revenue pre-profit companies. And in India, again, like in China, it's not early stage revenue. It's later stage revenue, most of the investment, just before they turn profitable. That means they like to invest when they already scale up and fuel the growth into profitability. That's really the sweet spot of of India and of China, those in particular. And then the oddest country of all is again in the profitable sector, it's really China. If the US and Europe have an average of about 8 to 10% of VC investments done into profitable companies, then China is at any given year about 30 to 45% of all the deals done into profitable companies. And by the way, almost half of it is a first-time investment into a profitable company. That's super rare around the world. It's very rare to find. So that is very, very China. That's very China. And the consequences and the results of it, I'll show you in a minute down the road. This is a very quick one, just to show you again by stage of development of the companies, the different geographies. Let's look at initial rounds, the first round of institutional VC financing. Where does it go in? If you look at the bottom one, which is the yellow and the dark gray one, this part is what we call the pre-revenue. The pre-revenue side. Let's take Israel as an example. Between 2009, 10, and 11 here, you have about 80% to about 50% of all investments in the first time are done in pre-revenue. In pre-revenue. Israel is really a tech early stage play. If you look at China, it's about somewhere in the range of probably 12 to 20% at any of those last same period of time of the years. So that is the first investment done. India, by the way, is almost equivalent to China. I skipped the slide because I have too many of those. But that's very important to understand. So the question then will be, and we can discuss this later, where do they get the money from in the initial stage? Because most of them, if you look at in China, it's an 80+% play is into revenue and profitable companies. So how do they get funded before that, right? That's a very good question to look at. If you look at in terms of amounts invested, in terms of industry split, you can see that in US and Europe, it's a fairly strong tech play. All over, it's a fairly strong tech play. In IT, healthcare, which is mainly life sciences and medtech devices, into clean tech, and then the rest of it is the financial and consumer services. If you look at, and that's a quote stable, it has some up and downs and flavors and favors, but if you look at how substantially the China and India is changing, it's an incredible consumer and service play. Forget the tech almost at the moment, right? It's very little tech, and I'll give you actually an additional layer of insights. If it is like 70, 80% here in India, and the same thing in China, the reality is, even if the Indians and Chinese come to me and say, well, we have still 20% or whatever percent in IT, 7% in healthcare, I say, yes. So what? It is still 50% in, oh, actually, I just see the number is wrong. It should be 70% in India is still a service in the IT industry, and in China it's about 50%. So it's more than half of even IT and life sciences is actually a service play. It's not even a tech play. While in the Western world, in the mature markets, it's much more a tech play than a service play. So that means China and India are still in the stage substantially on services. And there's nothing wrong maybe in a sense of that's also needed. And VCs and investors like to take the low-hanging fruits. And the time will come where that will change and flip. And I'll show you what's changing right now, as I speak actually, in those countries, particularly in China. If you look at pre-money valuations, there are some variations in the US, Europe extremely flat at very low. I'm coming back to this in a second. Then you see India goes up and down. NS means non-significant. That means that we didn't have enough deals to really make a meaningful statement. I don't feel comfortable on that. And then if you look at China, it's an amazing high valuation play. And why is that? Let me explain you this. First of all, because it's a very late stage play in China, naturally the deal sizes are much bigger. Therefore, the valuation is much higher. That's one of the reasons. And then also some of the markets have been kind of a bit overheating. I'm coming back to this when it comes to the exit side. The same thing is absolutely true for India. I'm telling you, if I had a choice to invest today, this is my very frank, open opinion here. If I were to play in India, I would not go late stage pre-profit and profitable companies in India. That's way oversaturated already. I wonder how these guys are going to make money out of it. There will always be the exception to the rule, but that's my personal view on this. And so that's the late stage focus. In China, I'm coming back to this, but very important. I mentioned this across. The valuations on IPOs have just come down 40 to 50% this year alone. This year alone. And people will say, why should I invest in China? Now let's look at this. China was doing so well in terms of venture-backed IPOs exits. The PE ratio on the absolute amount capital raised and the performance was so good. And I made a statement 2 years ago. I said, even if China crashes half, it's still doing better than the rest of the world, most of the rest of the world. That was my argument, and still true. So you see the valuations have come down at IPO about 40 to 50%. And so what? That means the returns going forward for those who invested just recently, they will be hurt a bit. But again, the valuations overall, you will see them come down because the VCs are now just now starting to adjust to the actual value at the exit. That's an automatically ripple effect backwards. So let's look at a few IPOs. Before we look at IPOs in the venture space, you have to understand the global market of M&As and IPOs. So it is very important to see that. I remember the days, I'm doing this a long time with Ernst & Young for many years. There used to be the number of transactions, deals in IPOs used to be at 60, 70% the US, historically for many, many years. And what has happened is that in 2010, which are the yellow numbers, you can see that Asia in 2010, of course, with the Western world being shut down almost, at 63%. But even in Q3, which is just the latest data I got, it's still more than half of all the deal done out here in Asia, Asia Pacific. And so if you want to understand venture and exits, you need to understand, is the market, liquid? Is it booming or is it not? And if so, where is it? And that's the piece you need to understand. Put this in a global context overall. The other question that I'm always curious is, what proportion is the VC-backed companies on IPOs to all the IPOs? What proportion is VC? And you can see that in yellow. It varies substantially year by year, a bit in the US, typically about a third. There was only 1 or 2 years in history. I calculated around 99, 2000, where the VC-backed companies actually, proportion was just above 50%. Every time, otherwise, it's in the 20, 30% type of range. Europe has been very stable in about those 5, less than 10%. And Israel is hard to predict because Israel is more of what I call an acquisition play, a technology acquisition, heavy acquisition play, even if they have a large number on NASDAQ already, but that's the reality in absolute numbers. And then China was super flat in the almost 10% range, except as of end of 2009 when they started opening up the new exchanges, the SME exchange in Shenzhen. And that really opened the gate and a flood of companies actually going out. And I'll show you the number in a second. But that's really important to understand that now you don't only need to exit the companies in Hong Kong, in NASDAQ, or Singapore, or even London or Europe somewhere. They now have a new gate, and it's really flooding. You will not believe it. If you look at the IPOs, which are now purely venture-backed IPOs around the world, then you have the US here about to recover from the 2008 and 9 financial disaster, and Europe is sort of slightly coming back. That was the first time in history when Europe overtook actually the United States, so in terms of number of deals, and then you could also see the capital raised at the IPO. that's not the full valuation. It's the capital raised at IPO. That means a certain proportion of all the shares only, 10, 20, 30, 40% will go out at the IPO in public, and the rest is still being kept. So, but it gives you kind of an indication where it goes. Israel is a very small IPO play in general, given the amount of companies they typically have, because as I said, most of it comes through acquisitions. And then China, you could see suddenly, is an amazing flood. When everybody shuts down, China opened up the gate. And it was just like a waterfall in there. And it's even not only the number of companies. Look at the amount of capital raised. We're talking 4 billion, 20 billion, 13 billion. While in the US, look at this, at any given year, it was like 7 billion at the peak. Wow. So these are Chinese companies who exit somewhere in this world raising that amount of money. That is why so much money went into China again. The investors could see the returns, right? Yeah, some of them got burned. Not everybody's a top quartile, but overall, you need to look at China as an amazing story. Going forward, we can have a discussion afterwards, right? And then you look at the M&A. Now, you need to understand a very important element is you have an IPO market to exit for investors. You also have an acquisition, the corporates acquiring the companies. And what that means is, ideally, you have somehow a great balance between the two. If you only have an IPO market, then everything is IPO driven. As long as the market is liquid, it's a great story. It's cool, right? But what happens if the public markets are kind of shut down? Take Japan at this moment. I just came on my trip also over to Japan. The VCs cannot exit the companies. If 90%, like in China, like in India, exit through IPOs, that's okay as long as the market is open. The dilemma is, in the US, about 90% get acquired at this point in time. And the prices are still reasonably good, I have to tell you. I mean, still reasonably, even in the financial downturn, the prices are still relatively good, okay. Now, ideally, you have a market, because if you have an IPO market and an M&A market, you say, okay, I don't need to sell. I'll keep it another 1 or 2 years or 3 years, and I will exit on an IPO, right? While corporates now, they also have, some of them have deep pockets, about 300 billion on the IT firms only, and the top 20 are ready to invest. That's a very good sign, by the way. And so ideally, you have both a vibrant market, ideally in an ideal case, IPO and M&A market playing reasonably well. And so if you look, if you look at, the US is kind of relatively flat. It came down in the downturn with the uncertainty in the market, but the corporates actually have the coffer fairly full. Europe has been on a steady decline. Europe is not looking that good, trust me, even if there's still a reasonably number of deals, but it's less than half of what it used to be. India is an IPO play again, means the companies need to exit mainly through an IPO. There's very few acquisitions. And China is about at the level of kind of India. It's almost meager. It's really small if you look at China. So over 95% exit through an IPO. And I see, looking forward, I'm coming back to this, you will see changes first happening then in China. Another important thing, so when you talk about returns, IRRs for investors, is the holding period. So we look at the first institutional investment, venture capital, until the exit, which is an M&A or IPO, or when they go belly up, they're not here. And so you can see that it increased after the dot-com boom. It increased about to 6, 7, 8 years on an IPO in US and in Europe. The M&A market about 5, 6 years, which is still quite long. And then Israel, you can see they don't have a lot of recent IPOs, not enough numbers. That's why they're not there. But the M&As were still holding actually actually a very long time. That's quite surprising. The reason is that Israel is really a very early stage play. And because they go in so early with a startup from the very beginning, that's why it seems relatively long. While in the US and in Europe, particularly in the US, you have angel investors coming in much earlier at a substantial rate, which pushes now, actually, even the US VCs a little bit more up. And then you have China just holding, and same in India. China and India holding both in acquisition and IPOs like 2, 3, 4 years because of the late stage investment on the first round. Okay, that makes sense. What you don't have is what I call these amazing super home runs in China. Very few of them are in the first place, and even if you have, the multiples are not that extreme. But in general, the median of the exit multiples is quite high in China, at the relatively low risk. That's what you need to take into account. What's the risk behind this?